Welcome to the All Financial Hour podcast with Steve All.
A lot of folks are saying, hey, look, after the election results of him winning, the market just skyrocketed. It's already been up and it's been doing great, but now look at it, it's going bonkers, and a lot of folks asking themselves, okay, when he returns to the White House, what can we expect from the market? Well, here's researcher Ed Yardini on CNBC, and he believes that the rally is going to continue.
The stock market's roaring because it's anticipating that we're going to get more tax cuts, that we're going to get deregulation, and that those will offset the negatives of some tariffs, clearly, and maybe more government spending. So it's a very fluid situation, but at the end of the day, I think the market's saying that the outlook is pretty good.
All right, so Steve, let's break this down here. I mean, again, the market's been sitting at all-time highs. It went up, of course, again. A lot of folks riding this wave with no protection, with no, sign of things changing, just pretty much counting on rainbows and unicorns. What are your thoughts on this?
Well, I just look at it to the point when you start to look at the markets. The only guarantee that we're allowed to give in anything by compliance is I can guarantee the market's going to do one of three things. It's going to go up, it's going to go down, or it's going to do the same. So that's kind of be where it's at right now. I agree with Ed that a lot of the bump came because of prospective tax cuts for businesses. That always brings in more profit. Less regulation. That cuts the expenses of businesses. So we do have those things that go up. But I've never seen a market just go up and keep going up and keep going up and keep going up. Mm-hmm. I think we have to remember that corrections, 10% declines in markets. When we start to get bear markets, 20% decline in markets. Those are parts of a market cycle. Those are going to happen. And the idea around it is are you prepared for whatever happens? Those 3 Ps. Steve, I want to participate in the market when it goes up. I would like some protection when the market goes down. And if you could get me a predictable income, those are the 3 things that I'm looking for in retirement. And I think that's where most people are looking at. Mm-hmm. So we have to look at it. Is now the time to go completely aggressive? We get the calls on election day that it's, hey, I don't believe in what just happened. Please take all of my money out of the market. I want to pay off my house because I'm going to have to go back to work because I'm going to lose my Social Security. And it was like, okay, let's calm down a little bit. I think that's the advantage of having a financial advisor. Because after we sat down, I just asked the question, is this an emotional decision? And he said, yeah, this is an emotional decision. I said, I think we need to just kind of sit back a little bit and look at what's going to happen. One, I don't think Social Security is going to go away. It could possibly be reduced if Congress doesn't do something about it. That's not going to happen. So we put these things and we just kind of sit back and breathe. And I can still remember talking to him, and I basically said, the only promise I'm going to make, the guy that called an hour before you did, that says now that the election's over, he wants to go full, 100% aggressive as I can possibly get him in the market. I had the exact same conversation with him. Do you think this is an emotional decision? We might want to sit back and watch what's going on. So I think that's the advantage of having an advisor when those emotions kicks in, that somebody can help talk you off the cliff. So I look at it for us. Is it a good time? Or market's all-time high? I'm going to go, we'll fast forward 5 years from now, and what the market did this last week is probably going to be irrelevant. About the easiest way to put it. Do you have a plan that no matter what the markets are doing, that you're going to be okay? I like the fact that we do both sides of this fence. We're holistic. I can get you the portfolios that are as aggressive as you possibly want to be. And they can also get you the asset protection that cannot go down due to market volatility. 2 different tools. Aggressions in the market can't go down due to market volatility is in the life insurance area. It's done in an annuity. Cannot go down due to market volatility. And I think those are the main things that people have to look at. Because when I sit down with my clients and talk to my clients, that usually is the exact same thing. Do you have the capacity for risk? Yes, I do. Do you have the attitude that if the market can go up or down and it's not going to change your mood for the day? Yes. Then I ask the question, do you need to take as much risk as you're possibly taking? Most clients don't. Because I asked that question, if the market's up 40%, is it going to change your retirement? No. Mm-hmm. If it's down 40%, will it change your retirement? A lot of my clients, the answer to that question is still no. But it would emotionally and psychologically. So are you protected when the markets turn? Because that's about the only thing that we could say. It's not going to go straight up. We are going to have a downturn in the market. And I believe having somebody like Market Guard to assist us with conservative portfolios, aggressive portfolios, stock portfolios, or ETF portfolios, I think that is the greatest thing that gives us the opportunity to help you, the client.
Now, Steve, for those that are thinking maybe they were supporters of President Trump, they think President Trump's going to save the market and save their retirement and save their money, thinking, I don't need to talk to a financial advisor. Everything's going to be great. What is that first appointment like, and how important is it for them not to keep those blinders on?
Well, what we're going to do is we're going to sit down and we're going to do an analysis around where you're currently at. I want to know what your wishes, hopes, and dreams are, because everybody that walks in, those are completely different goals for everybody that comes in. Then we're going to look at that risk-reward analysis. How are you going to replace your paycheck once it comes time to retire? And what are you doing about legacy and long-term care? Because I think those are part of a plan that if you're just looking for an investment, you don't get that information. I believe it's very important to know legacy, long-term care, risk-reward, and how am I going to get my income? That's what we're going to talk about as we gather the information from you, bring you back, and give you a summary of plan that talks about those pillars of the retirement plan.
Now, we've talked before, Steve, about making catch-up contributions to your 401k. But now, thanks to a new law, you can make a super catch-up contribution in 2025. So fill me in on exactly what this is, what's going on here, and if somebody is eligible to make this super catch-up contribution, when, how does all this work?
Okay, the X's is for those people that did not save enough during the younger years. Maybe the kids were going to, education, high school in St. Louis is very expensive, college, all of those things. So they did not have the XX funds and they're behind on their contributions. And it does allow somebody that's between the ages of 60 to 63 to add to their 401k. So it gives you the availability to add additional dollars. But if your income is greater than $145,000, it has to go into a Roth account, which I think could be very advantageous for some people. And we have to look at this in a lot of different areas because I believe that having too much money in your IRAs and 401ks could subject you to tax rate risk in the future. So if you're not in that category, I would say let's do these catch-up contributions if you got the extra money to do it. But if you've been doing it all the way along, I would prefer not to pass that tax time bomb onto your kids because the Secure Act took away that stretch IRA where our children could stretch their IRAs over their lifetime. And then if they prematurely pass, our grandkids could then do it over the balance of our child's lifetime. The Secure Act says that money has to come out of that tax-deferred shell in 10 years. So we've lost one of those great estate tools that we used to use. You put the money away, you put it, goes to the kids, they can stretch it over their lifetime, take it when it's tax advantageous for them. But if you're in that category, too much, you could pass that tax time bomb. If people ask, Steve, what do you mean when you say too much money in an IRA? I look at it, if you have $250,000 to $750,000 in your IRA account, you've got an extra large IRA because the average balance in 401ks is about $170,000 to $180,000. So it's not that great big number that a lot of people are thinking. And if you're in that $250,000 to $750,000, depending on whether you have a pension or not and where you're at in your lifestyle expenses, you might spend those assets down during your lifetime. So a lot of tax planning might not be necessary. If you've got a double X between $750,000 and $1.5 million, chances are you're going to pass those assets on to your kids. And if you've got a triple X, 1.75 million or more, chances are you are going to send that tax time bomb onto your kids. They're going to have to take that balance out over 10 years. So if you're thinking about how much do you have in your IRA and your 401k, I'm not saying you could get 7%. I'm just saying using that number, it's easier to do the math. In 10 years, if you average 7%, you're going to have doubled the amount that you currently have. So if you've got 10 years, double the amount that you just thought about. And if you've got 20 years, double it again. Now look at it and say, if my kids had to take this out over 10 years, how much would they pay in taxes? And that's what we have to look at when it comes to taxation. This year, there's got to be new tax laws brought into place. I don't think that the current administration will be able to do whatever it wants. Yes, they got the White House, the Senate, and the House, but what are we talking about? They don't have 60 in the Senate.
Sure.
So they have to work with both sides of the party here. It's not just, I want to do this, it's done. They got to come together and they got to compromise. So they have to do it, because if they don't, the Trump tax cuts of 2017 will expire at the end of 2025. I believe they will make them permanent, but they're not going to be exactly as it looks now. We will have a new tax plan. I've heard people come to me and say, Steve, we're going to have a new tax plan probably in March. And I'm going, folks, no, they got to get all this through Congress. It's probably not going to come around until late summer, early fall. So we do have to do this. But taxes, eliminating or reducing taxes, is the most important thing you can do for successful retirement. And I believe that that's what we bring to people that a lot of people don't have. I get a lot of people that come in and says, well, my guy won't talk about taxes. My statement of it is, come in, let's sit down, let's do a tax analysis and find out, would it make sense for you to look at Roth conversions, different things that we can do for taxes, move it into different taxable shells so everything's not in the same bucket.
You know, this year, the average monthly Social Security benefit for retired workers was nearly $2,000. An article I read on MoneyWise talked about the ways that you can lose that payment without warning in retirement. So these are some red flags, folks. Not paying your taxes, not making federal student loan payments, and being in prison. That's a big red flag. So
yes, avoid that one.
Yeah,
it's more than Social Security. Please, avoid that one.
Yeah, please stay on the outside of the bars. Yeah. Another way to lose your benefit is if you exceed something that they call earnings test limits. So break this down for me. What does this mean, Steve? And is it something that you can help us prevent?
The annual earnings test is what they're talking about. You're only allowed to make, this year it's like $22,300, and next year it goes to around $24,000. So if you make more than that in a year and you're under full retirement age, there is a penalty. They will deduct $1 of your Social Security for every $2 that you're over the annual earnings test amount. Now, if you did, and they did withhold, you will get that back starting at full retirement age, but it won't be a lump sum check. So the idea around it of it is where do we fit in this? And I can't make too much money. Why? Well, Social Security was designed for people that outlived normal life expectancy. When I tell people that most people don't realize that when Social Security started, you had to be 63 years old to receive Social Security. The average life expectancy for a male at that time, and there weren't that many women in the workforce, so I'm not trying to be sexist on that one, was 62. They had outlived life expectancy. It wasn't designed to be a retirement plan, but it fairly well is now. We had three parts of the triangle. We had pensions, we had Social Security, and personal savings. Now, pensions are pretty well gone without very many industries. And Social Security is wobbly right now. They have already stated that if they don't do something to fix it, it's probably going to be cut in 2033 to 2034. So they are going to have to do something to get that taken care of. But right now, the most important thing you can do is optimize your Social Security. Get the most that you can. As a single person, it's a lot easier to figure out what that optimum amount is. As a married couple, I like to look at benefits for the survivor. I think that's very important when you talk about when are you going to take Social Security.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisory requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.